Welcome to another Coffee with Samso. We are here at the University Club here in Crawley on the campus of the University of Western Australia. Today we have Iron Bear Resources Limited. ASX code is IBR. Iron Bear used to be called Cyclone Metals Limited with their previous code CLE. For those who have not been following the story, Iron Bear has an iron ore project in the Labrador Trough in Canada. It is a magnetite project and they are in that developmental stage. We will have Paul Barron here with us today. He's the managing director of the company. Paul was on our platform in May 2025. So it has been a while, and I'm looking forward to getting him to walk us through what's been happening with the company since then. I'm a shareholder of Iron Bear and has been a shareholder for the last couple of years. Vested interest in the project, but also interested to get that story out to the general public. For those who are not familiar with the Iron Bear story, the Labrador Trough is an iron ore region. Rio Tinto is working in there. Champion Iron, who is an ASX listed company, also been operating there for the last almost 10 years, I believe. For those that are not familiar with the Iron Bear story, they are an iron ore business that's working in the Labrador Trough in Canada. It is an iron ore region. Rio Tinto is present there. We have ArcelorMittal there as well. Champion Iron, which is an ASX listed company, has been having an iron ore operations there for almost 10 years. Takora Resources and Tata Steel have an operation there as well. So it's not a region that's reinventing the wheel. It is a well-heeled region for iron ore, and they have a lot of infrastructure in place. So interesting story. So I implore you guys to sit back and take it all in. I just want to take this opportunity to thank everyone that's been supporting our platform, whether it's been on YouTube or on our mailing list on our website. Thank you very much. It has been a long journey since 2019 when the first episode of Coffee with Samso came out. So thank you. And for those that have not yet joined us, please do subscribe to us. Get yourself on the mailing list. There are several ways on our website that you can support us. It does help us to get our content out there for those ASX investors and people who are interested in this sector. And as I always say, grab your favorite beverage, sit back, enjoy the Coffee with Samso. Welcome to another Coffee with Samso. As we said, I've got Paul Barron here with us from Iron Bear, and we're going to be talking iron ore, green iron. Welcome back, Paul.
Thank you for having me.
It's been a while. May 25 was the last time you graced your presence with us. Look, as I said, look, for viewers who are new to Iron Bear, can you just give us that simple picture of what the project is and why it matters today?
Sure. So in a nutshell, Iron Bear is a iron ore project in the Canadian Trough. It's a magnetite project. And it's located roughly 35 kilometers north of Shefferville, so maybe 500 k's to the north of Quebec City for those who are a bit familiar with the geography in Canada. The key highlights of the project, first, it's a very large deposit, so it's very strategic, long life mine over 30 years. It's located next to infrastructure, and so we have access to heavy haul rail connected all the way down to a deep sea port, which is Sept-Îles and Pointe-Noire. It's a project which has the unique characteristic of being able to generate very high grade iron ore concentrates, which are referred to direct reduction concentrates, which sell for very high premiums, are a key part of decarbonisation of the steel value chain. And it's a project which had the support of Vale, and Vale being the world's largest producer of iron ore in 2025 and dominates this high-grade iron ore market. And so we have the privilege of having signed a development agreement with Vale in February 2025, which provides us with funding all the way to decision to mine in 2 phases. a first phase of $18 million US and a second phase of $120 million US. So I think that's pretty much, in very short and very compressed, what the Iron Bear project is.
Okay, fantastic. I mean, we'll get you to elaborate on that story. Look, we've seen a lot of discussion globally about steel decarbonisation, which you kind of mentioned there, and you kind of briefly mentioned about Iron Bear's positioning or narrative. What can you tell us about how if we take the global picture into where Iron Bear and what Iron Bear could mean for the bigger picture?
Well, I think there's probably two dimensions to look at. One is the iron ore industry as a whole. I'll talk about that briefly. And then there's the decarbonisation of the steel industry. So you look at the iron ore industry as a whole, you're talking about 1.8 billion tons of iron ore, which is traded every year. It's the second largest traded commodity after oil and gas. And it's generally a very high value commodity in the sense that the companies which dominate this space, be it Rio, FMG, Vale, are very profitable organizations, and they are throughout the cycle. And iron ore generally is linked to GDP growth of the world, so it's a very stable and secure commodity, even if it's not generally a high focus with retail investors, because there's a perception that the industry is dominated by the majors, the three majors that I mentioned, BHP missing, so we add those in, but if you add those in, the majors control maybe 75% of the market. And it's a very capital intensive industry which requires infrastructure, access to heavy haul and rail. So it's an industry which is usually a bit under the radar, maybe considered boring, and I would argue that it's not boring at all.
Agree.
But what's important about the iron ore industry is highly concentrated, it's a high margin industry, and it's an industry which cannot grow negatively, if that makes sense, right? Because it's linked to the world production. And it's also an industry where the high grade, there's a very high rate of depletion of iron ore reserves throughout the world. And that's a factor which is overlooked by nearly every analyst, except very specialized analysts who see this. The major investment banks, the American banks, they never take into account depletion of iron ore reserves. And that's combined with the drop of the quality of iron ore. And so what that has done, it's shifting the iron ore space from much more high value add in the high grade ore space and an oversupply of lower grade ores. Does that kind of make sense, Noel, the way I'm putting this? So let's put a few numbers around this, right? So typically, and let's take, for simplicity, a 2 billion seaborne market for iron ore, right? So typically, the iron ore market grows at GDP plus 1 for a developing nation, and GDP minus 1 for a developed nation, right? So, and it's debatable whether China is in the GDP plus 1 or minus 1 space. But if we just assume that it grows with world GDP, and let's say world GDP grows by 3%, so you've got an additional demand for iron ore structurally of about 60 million tons per annum, right? That sort of makes sense. Add to that a depletion rate of roughly 70 million tons per annum, and that depletion rate is just, mines getting depleted. Christmas Creek, for example, of FMG, was very highly advertised. When FMG got into production, that mine doesn't produce anymore. Hammersley Iron doesn't produce anymore from Rio. So depletion is something which is real that people ignore. The number of 70 million tons is not my number. That comes from Vale. So, the CEO of Vale, when he was talking at PDAC in March this year, actually said, look, those are the projections that Vale has. So you're losing 60 plus 70, call it 130 million tons of supply or required additional supply in the market per year. And to put that in perspective, that's the whole of Simandou. So when you hear, analysts saying, I know Simandou's coming online, it's going to saturate the market. When you hear people say, the expansions of Vale are going to saturate the market, they always ignore the natural depletion rate and the natural growth of the market. If that sort of makes sense. Simandou will be absorbed, all of its production in less than a year. And if you look at iron ore prices, they're currently sitting around 105 USD per ton, so that's the benchmark delivered in China, which is a 62% Fe grade product. Those the prices have remained very stable, around $110 to $115 a ton over the last 5 years, and they're currently about 105. The reality is, iron ore prices have not dipped below $90 a ton for any extended period of time. I'm not talking 2 weeks here and there, for a decade. So, when you look at analysts who predict, and I'm talking about investment bankers, Merrill Lynch, those types of people who see iron ore prices dropping next year or the year after that to 60, 65, 70, $80 a ton. That's never actually happened. And that sort of very bearish view of the iron ore market has been consistent for the last 20 years, and it's never happened. Insiders are incredibly bullish on the iron ore market because the depletion rates are accelerating. So I personally believe we're heading for a very aggressive bull market over the next year, maybe 2 years. And you can see how stable and resilient iron ore prices have been. And it's driven by depletion, and it's driven also by the fact that you have a highly concentrated, you have huge pricing power of suppliers in this market. So that's, Noel, what I would say is the picture of the iron ore market per se. Now, if we look at the steel industry, and let's start being a bit more granular, talk about decarbonization. The steel value chain is 8% of the overall emissions of CO2 for mankind, right? It's huge. And we're talking about 2 tons of CO2 per ton of steel produced. And 70% of steel production, or 75, depending on what source you look at, is using the blast furnace route, which is essentially using coal to make steel, in a nutshell. The other popular route, which is something like 8% of the market today, is the direct reduction route, which is using natural gas to make steel. And when you use natural gas, you halve basically the carbon footprint. So that actually moves the needle quite a bit. And there's a large supply of cheap natural gas around the world. A bit less so since recently the Iranians and the Israelis have been bombing all the natural gas fields in the Middle East. But in spite of their joint efforts, there's still enormous amounts of natural gas. It actually, interestingly enough, and I'm joking a little bit here, but there's some truth in it. If you can't ship the natural gas, you have to do something with it, so you're much more likely to make steel. But all jokes aside, so what we're observing is a very high growth of that subsection of the steel industry, which is a natural gas-based steel-making route or direct reduction route. So that is anticipated to double over the next decade. And here is the important part for Iron Bear, is in order to make steel using the natural gas route, you need direct reduction pellets. There's no way around this. And direct reduction pellets are a very, very high value, difficult to produce type of iron ore or iron ore product, which sells at a 40 to 50% premium to conventional benchmark iron ore. And if you consider that that premium is, call it $40 to $50 a ton, US, and you consider that the additional conversion costs are roughly $15 a ton, you're essentially increasing your profits by $35 a ton, so which is 35% profit margins additional.
On the
based on the benchmark. I'm assuming a benchmark at 100 to make things simple. But if you if you made, say, $50 of profit on a benchmark product, you would make 85. Sorry, plus 30. So you would make $85 a ton profit with DR pellets, including the additional conversion costs. So it's a super high value product, a super high margin product. The catch is that there's only 3 suppliers in the world on the seaborne market for DR pellets. One of them is Vale, which has about 60%, and which is our partner, and this is not a coincidence. And the other one is Rio Tinto with IOC, and then you've got Samarco, which is actually a JV entre BHP and Vale. So you have an incredibly concentrated market. You have very constrained supply, and there's very few deposits in the world which can produce this type of product. It's the bottleneck. And as I said, this market is doubling over the next decade. So it's a very, very exciting space to be. So an Iron Bear is poised to dominate that direct reduction space. And maybe I can say why, because that to bring it back. So the deposit we're looking at is a magnetite deposit. Magnetites have a much lower carbon footprint than hematites. I won't be too technical about that, but the deposit is huge, right? We're looking at 16 billion tons JORC compliant inferred and indicated. That's going to be upgraded. We'll talk about that in a second. So we have a huge resource. We're 30 k's away from a heavy haul rail, which means we have access to market. The product, we've been able to produce direct reduction pellets in a pilot plant, bulk samples, which are absolutely world-class and have, even in the DR pellet market, these are the only magnetite DR pellets who have the lowest carbon footprint. And so we have demonstrably the capacity to bring huge amounts of these pellets to the market. And because we also, and this is another very exciting aspect of the project, we have a very low stripping ratio, so low mining cost. We have access to cheap hydropower, so renewable power. We also have very low cost. You'll note that when people talk about hydropower, they think about low carbon footprint. Yeah, we have all of that, but what is much more exciting is low cost. And so when you look at this collectively, we have the ideal project that fits perfectly into where the market is going in terms of the overall steel value chain, decarbonization. We provide the key ingredient for that decarbonization. No DR pellets, no DR steel mills. And DR steel mills are very competitive compared to blast furnace steel mills in today's market. So not only is it important for decarbonization, and it matters, but also it is just cheaper and therefore more economically viable than the blast furnace route. So I'm very excited about that. I don't think iron ore is boring. I think that what you'll find is as you get lower grades of ore in Australia where there's a phosphorus problem, in Brazil where they have a manganese problem, you see the depletion of a lot of the high-grade ores in the world. Having material of this quality that you can use for blending as well and being able to unlock this DR value chain is just incredibly amazing. And we're very privileged to have this project. And I'll add that it's not just my personal opinion. Clearly, we've been able to bring Vale on board. They understand this market better than anyone else, and they're funding us. So clearly, this is not a junior telling you something. This is a junior which is backed by the world's dominant power in the high-grade iron ore space.
So on that point, I guess, I'm go back to your statement, iron ore is not boring. I always say that the boring business are the ones that makes the most money.
Right. And
no business, if anyone's been in business, they will all vouch for this. There's nothing that's easy, and the detail is in the devil, right? The devil's in the detail.
I'd invite people to look at the margins in the iron ore business of companies like Vale, BHP, Rio, FMG. It's a very profitable business.
Yeah, I mean, I don't think there's any doubt. But on that point, what is, you have a low market cap. So in my question is, and I kind of think there's a reason. What is the missing element in that story, right? What do you think people are not getting, or I don't know, they're not getting? Is it a case that they're not getting?
Yeah, I think there's a couple of things. I mean, one is, and I'll be really honest, because we're entirely funded by Vale, we don't need to go to capital markets, retail markets to fund the project. And so we haven't put a lot of focus on communicating to retail markets the way we should. And that's been compounded by the fact, as you know, we've had a lot of board changes in 2025. We've had the departure of Tony Sage, who was the executive chairman. We've had the departure of other directors and the arrival of new directors who are more tuned to this focus on iron ore. We have Kawe, Rojo, who's joined the board, who is a former Vale employee and who's Brazilian. Now he's Australian. He's like me. He's an import, but nonetheless, there's been a bit of a reset of the board, and that's actually led to some investors, like EU1 in particular, selling out. So that's dampened a bit the share price. So I think that's fair. The other thing, but I do believe that the markets don't really understand that we are fully funded. One of the challenges you have with these iron ore projects is they're very capital intensive, right? And typically markets do not like companies which have very capital intensive projects because there's skepticism as to the ability to raise money. Now that's true at the development stage, and I'll illustrate that, and also at the capital project stage. Put it like this: when we acquired the project, the Iron Bear project, which was called Iron Block 103 back in the day, in 2023, Iron Bear Limited, or Iron Bear Resources Limited, were then called Cyclone. We changed name, which was confusing, but anyway, we had a market cap of 10 million, and which means you can raise maybe 2 on the market reasonably. While the development costs of a project like this are more in the range of $100 million US. So, brokers will look at this and go, yeah, it's not going to work. With a market cap that small, you can't develop this. So there's skepticism. And then when you even look at the capital deployment side, the challenge is, well, I need $4 or $5 billion of pre-production capex, and those numbers can vary a bit, but that's sort of magnitude. How does a company with a market cap of 10, 50, 100, 200 is typically the kind of market cap you get at a PFS. How does a company like that raise that kind of capital? And so there's a lot of skepticism that iron ore projects, unless they come from a major, can get up and running. There's 1 or 2 exceptions like Phoenix, but they have a very agile sort of model, high cost, very agile. And very low levels of production. They don't build any infrastructure.
It's a much smaller...
It's a very small operation, but it's very agile, very high grade, and all credit to them. It's a very good business model, but it's not a business model that you can scale up. The way we got around this was by hooking ourselves up with Vale, who has the balance sheet, the resources, and securing from a private investor the development capital that we need to the tune of $138 million US. And so I think that unlocks the project. Now, are capital markets aware of that? Are retail investors aware of that? I don't think so. And I think we have to do a better job communicating that actually we have a solution for the high capital, for the high development cost. We have a solution for the high capital cost, which means that we have a pathway to production.
Yeah, I think that's, I believe, and I declared that I'm a shareholder. I think that's the missing links. People don't.
Yeah.
It's such an intricate business that needs that following. Like you said, Vale is there, and the business is it's actually so much bigger than the market cap of the company that someone like Vale and BHPs and Rios and or maybe even throw in Champion Irons of this world can see what is required and can see what you have, but the general part of the market probably can't appreciate that partnership you have with Vale.
I think it's undervalued, and we have currently, we've got over $40 million Australian in the bank in cash, which is not allocated to the Iron Bear project. It's just cash. We have secured at least $20 million US. So call it $30 million Australian of funding in phase 1. Phase 2 arguably is discretionary, but I'm optimistic that we're going to get to phase 2 without too much problem. And so if you add up just the phase 1 funding and our cash, you're talking at $44 million Australian. That's roughly our market cap. So we're essentially got our cash backing, but not only that, We've secured the next round of funding for $120 million US, so call it $180 million Australian. We have outstanding results from our engineering studies. We're pretty much on track with one exception that I will disclose in terms of our development. So it's quite extraordinary that we're not valued more than we are, but we're not rare earths. Iron ore is boring. There's maybe that dimension as well. And frankly, we haven't focused on this because for us, our lifeblood is obviously the development of the project and the funding of the project and working with Vale to get the project to decision to mine. And when we get to decision to mine, this is important for investors to be aware of, Vale will buy out the minority shareholder, aka us, and at that point we'll have 25% of the business left. So once Vale has expended their 138 million, they will have accrued 75% of the project, so that's worth noting. But when we get to decision to mine, they have to buy out the minority shareholder, and at fair value. If you look at the NPV, etc., you're looking at, maybe a $2 billion US buyout, and then we can argue about that number, but whether it's 1 or 3, who knows? But that translates to a share price of, $2 Australian, $3 Australian, depending on exchange rates and other factors. And our current share price is 4.2 cents.
Yeah.
And this is cash, right? This is not guesswork. And then and this is in a reasonable time frame. So there's a lot of upside. There's obviously some risk, but I don't think that's understood by the markets, generally speaking, to your point. And I think there's still this sense that the iron ore market is going to collapse and the Chinese economy is going to collapse and all these types of things. I'm going to argue that's irrational and silly, and it's maybe linked to some political propaganda, but there's no sign of the Chinese economy doing anything. Unless you believe that it's all going to fall off a cliff, iron ore supply and demand is going to remain very stable. And that's, by the way, what Vale thinks, and they've been very clear about that in their public statements and in their private discussions with us. I don't think anyone who looks at this objectively sees any major shifts in the steel production in China. And I will flag that India, for example, switched recently from being an iron ore exporter to importer, and seems to be going down the same route that we saw China in 2004 when they did the same thing. China was an exporter of iron ore. In 2004, they flipped. We're seeing that with India. So I think we might have some more upside in the market that is not factored in just by these nations sort of developing and becoming much more steel intensive. And you could throw in Indonesia, you could throw in Malaysia in there as well. That part of the world is becoming increasingly the center of gravity of the economies of the world economy.
I think that's one of the key aspects that people, out of neglect or just the fact that they've forgotten that the growth in economies was kind of the US, and then that kind of slowed down, and the Chinese picked that up.
Yeah.
And then that's going to slow down. There'll be another one that picks it up, and so on and so forth.
Yeah.
But, look, I know that one of the key things is obviously you released a scoping study a while back.
Yeah.
And where you're waiting on your PFS that's coming up. So I want to just set some scene, because obviously we understand what IBR is doing and the upsides and everything else.
Yeah.
Maybe we can just walk through some of the specifics and then get into what people are, the details of what we've been discussing. Yeah. The geology, I guess, what is it, and I know you touched on about this, and I think it's quite important, is what's it different from other large-scale systems that you've got? I mean, you do have a lot of billions of tons.
Yeah.
But what is...
So the main difference is I know the geologists are going to hate me for using this word, but it's the incredible cleanliness of the resource. The lack of contaminants and deleterious elements in the resource is the reason why we can make an incredibly clean concentrate. So our DR concentrate has an Fe grade of 71%. It has literally no deleterious elements, no alumina, no phosphorus, no manganese, nothing. And silica is about 1.2 to 1.4%, which is very, very low. And that's because this gigantic resource has this unique characteristic of being very clean. It's not so much the grade of Fe that is very high. It's a magnetite, so the grades are floating between 29 to 31% Fe in the ground. But it's the fact that it's incredibly clean, right, which makes it a candidate for this DR concentrate, and a candidate for blending and upgrading other types of ores around the world. So that's probably the main characteristic. And it also means that it has a very low carbon footprint because you don't have to remove all these deleterious elements from the steelmaking process.
And that's seen consistently through the ore body?
Well, look, obviously we're doing a drilling I'll start talking about our work plan in a moment, but fundamentally our initial test work, so we've done metallurgical test work at Corem in Quebec City. We've put through the bulk samples through the pilot plant, which has phenomenal yields and quality of product as an output. We put very low grade material and we put average grade material, and we've achieved absolutely identical results, which is fantastic. So that's a good indication, but we do need to do proper variability test work across the resource, which is part of our plan for 2026, which I'll talk about. But I'm quite confident we know the geology is consistent.
Yep. Okay. Well, you've just answered my next two questions on metallurgy, so we'll move.
Okay.
We'll move
Sorry
on.
to be disruptive.
But actually, have you got something to add to? Because my question sort of revolve around like what do you understand and what if there's any sort of things that might be kind of a risk on the business.
Well, I mean. Yes, there's risks, and we can talk about that. But if you ask me what I think is a main risk, any mining project has a environmental cost, right? And obviously it has benefits, both financially in terms of economic development and socially. But it's always a trade-off, and you have to get that balance right. And that's flows into your social acceptability. So I would say that is probably the number one risk. We have local communities that need to benefit from this. We have shareholders who need to benefit from this, and we have the government which needs to benefit from this, and we have to minimize the costs for the environment. And we have solutions for these things. But getting that balance right is probably the number one risk. I don't think there's much risk from a logistic perspective. Yes, we have to access the rail, but if we can't access the rail, we can put a slurry line in, so we have plans there as well. Yes, we have to confirm the metallurgical properties of the resource. That's fine. Confident with that. Yes, we have to confirm the economic value of the project. We did a scoping study which was released in August last year. We're now doing a PFS with Hatch, which will be released most likely mid-May this year. So those numbers have to confirm that the project is good. I'm confident in all of those things, but the social acceptability is probably the biggest challenge. And I do believe that we do bring some unique technologies and approaches to the table to make this work, which I'd be very keen to talk about.
Yep. I guess that's probably a good time to talk about it because because the key is obviously what everyone's heard. The upside was the key that you are concerned with, or you are paying attention to.
So if you think of social acceptability, let's start with the social component, and then we're going to talk about the environmental component. So in terms of the social component, historically, the First Nations have been left out of the benefits, let's call it like that, of mining, and particularly in this region, right? Shefferville, where we're based, is actually historically a mining town. So there's been iron ore production in Shefferville since the mid-50s, all the way from IOC all the way to the mid-80s, and it was a thriving mining town. And then IOC shut down, and there's a lot of history there. There wasn't proper rehabilitation of the environmental damage which was done. There's lots of open pits. And clearly the First Nations, who are the majority of the population, I would say 90% currently, did not benefit or benefited very little. And so there's a lot of frustration, and it's very hard not to feel empathy to the populations there. There's two main populations in that region. There's the Makimitush Innu or Lake St. John, Makimitush Lake St. John Innu, who are based in Shefferville, and then you have the Naskapi, who are based in Kawawashi-Kamak, which is about 15 k's away. So they're the vast majority of the people there. They haven't really benefited in a way which I would consider fair from previous mining operations, and so we need to correct that, and we need to involve them properly in the project. And ultimately, in my view, they have to own this. It has to be their mine. It has to become the economic anchor for the region, because the truth is, if those communities are going to survive in the modern world, they do need an economic anchor, and I think if this is done properly, it can provide that. The second part is environmental, and how do you mitigate the environmental costs of an operation like this? And modern mining operations obviously are much better than historical ones, but there's a unique technology that we are planning to deploy, which is dry tailing. So the main source of environmental cost for an iron ore mining operation are the tailings dams. And as you're probably aware, historically, Vale has had some major issues with tailings dams, with two major tailings dams collapses, which unfortunately were tragedies which cost many, many lives. But as a result of that, the company has completely changed its perspective, both on how to manage tailings, in other words, don't have them, which is, and as well as how they look at sustainability. And so Vale has developed over the last decade or so some incredible technologies to use dry tailings, in other words, not to have tailings dam. And so one of our ambitions is to bring this dry tailing technology to Canada, where it currently doesn't exist, and essentially to rehabilitate our pits as we go along. And not only that, but we're also looking at rehabilitating the historical pits to sort of undo some of the damage. And that's still work in progress. We believe it's possible. We believe that an operation like this would provide the tools and the equipment and the resources to do it. But most importantly, we think we can keep this environmental footprint down to a minimum, and by systematic rehabilitation and protecting the areas around for wildlife and fish and lakes and stuff, we can do the same type of thing which Vale has done very successfully in the Amazon, where Vale has, in around Carajás, has been able to protect vast areas of the rainforest, which otherwise got absolutely destroyed in the areas not protected by the mine. So this is sort of the model that we want. So we think we can come up with a solution, but that has to be understood and supported by the local communities, as well as obviously the Canadian government. And on the last front, I'll say that there's been a massive shift in Canada following the Trump tariffs. And there's new governments in both of the provinces where we operate, which is Newfoundland, Labrador and Quebec, as well as obviously the federal government. But what is absolutely clear is there's now an absolute focus on getting projects like Iron Bear up and running, with more efficient permitting, with streamlined processes for just government engagement and engagement with all the various stakeholders engaged. So we're very excited about that, and we really want to be part of making Canada great again.
Look,
that was a joke, by the way,
yeah,
so
yeah.
I'm going to get in trouble for that one. But
yeah. I guess in some ways, I think what you touched on, that those Trump tariffs and everything else, do you think that's brought a bit more awareness that you need to have a form of nationalism on your assets?
Absolutely. Look, they're suffering greatly. Although Canada is a massive producer of oil and gas, they don't have any refineries, so they're in a difficult situation, even in areas where they have extensive amount of resources. They're also very dependent on the US for their exports and their imports. And one of the benefits of Iron Bear for Canada as a whole is the fact that either you would export the production to the Middle East primarily and to Brazil, or alternatively, you could use it as a springboard to develop very competitive, on a global scale, steelmaking capacity. So you do actually have that, it's very exciting for the Canadian economy in two very fundamental ways. A, no exposure to the American economy, or limited exposure, and the ability to build that industrial base where, and I could really wax lyrical about this, Noel, but if you use these DR pellets in Canada with local natural gas, the Canadians could build the most competitive steel industry in the world, period. Because you solve a lot of issues in terms of logistics. Bear in mind that when the Chinese produce steel, they import about 3 tons of raw materials from the other side of the planet, that's Australia and Brazil, per ton of steel produced. Just a logistical advantage of doing it in a localized way in Canada would be devastating, and then you could export the steel, which is way cheaper than exporting raw materials. Or you could use it to build things. So I went off on a tangent.
No, that's fine. I guess you touched on what your work program for 2026.
Yep.
Can you just give us a
Sure.
rundown?
So what are the key milestones ahead of us? One is a mineral resource upgrade. So it'll be in 2 stages. The first stage will be an upgrade of the indicated portion of the resource that we have, so which is currently around 2 billion tons. That will increase. And that's basically will be based on work done by Vale on the geological model. And so that will then enable us, when we issue our PFS, to have a reserve statement, to have mineral reserves. We have a drilling program for this summer, so summer in Canada, which is winter in Australia, which will enable us to increase the size of that reserve, but most importantly will flow into a detailed design of the pit or pits, and also enable us to start working out what the rehabilitation plan is going to be and what pits we would refill when and how we would manage the tailings. Another big deliverable that we have for this year is our Pre Feasibility Study, which should come out mid-April. So this is...
Mid-April, mid-May?
Sorry, mid-May.
Yeah.
Apologies for that, yeah. I'll have a draft mid-April, but the market's only mid-May. So this is being done by Hatch, and Hatch with inputs and the technical parameters from Vale and other parties, but primarily them. So that's a very key milestone, because that will determine, it's one of the key deliverables to go to phase 2 with Vale. So that's coming out mid-May. So that's a huge milestone for us. And then we will have the transition to phase 2 with Vale, taking into account all of the aforementioned things that I talked about. And there's a component there as well around, so if you look at the phase 1 and the phase 2, phase 1 is primarily a de-risking exercise. And so when Vale signed the DA, they wanted to make sure that we had access to power, access to infrastructure, that the social risks are manageable, and that it all flowed into an economic model which made sense. And of course the quality of the product. Most of that's being de-risked. And so what's really important now is what that economic equation looks like.
For the punters out there and shareholders like us, if you had to give us a gauge of potential positive movement, what would that number be? Without getting yourself into trouble.
Well, Yeah, I can't give financial advice. I don't think I'm either qualified, and you shouldn't believe a promoter anyway. But I'm very optimistic in terms of our future. And I'm optimistic because I believe that once we get our PFS out, we become a really good investment vehicle for a lot of funds who currently wouldn't touch a junior like us. So, if you look at comparables, if you look at companies which have PFSs, which have generally much smaller projects, you'll see that the valuations usually sit between 100 to 200 million, a bit more sometimes, just looking at comparables. So, and that in our case translates to 10 to 20 cents per share. When will that happen? I don't know. I don't have a crystal ball, but that's clearly, personally what I would be targeting moving forward, let's say over the next 6 months or so. And obviously that has to be underpinned by successful operations, but I'm quietly optimistic that we'll get there.
Look, we'll close up since the crowd has moved in, but look, I from my point of view, I guess I can answer that question for you, because
right.
ASIC and ASX not going to chase me, but I think just by virtue of the fact that the association with Vale and the fact that they've had the nous or the faith to put the money where their mouth is or where their thoughts are, kind of gives me anyway as a shareholder some vote of confidence that we're on the right track. But as we know, there's a reason why there's two words called black swan events that happen. But
yeah, look, I think we haven't talked about the corporate side of things, but I think we're in a very good space now from a corporate perspective. I think all of that's behind us, and I think that's the key message here. There's been some, one or two large shareholders who have exited, and that's dampened the share price, no doubt. But from an operational perspective, from the relationship perspective with Vale, we progressed very well. Vale has extensively looked at the project. They've sent their rail people, their geologists, their metallurgists. I mean, trust me, they've been crawling all over this project, and so far, I think the results have been fantastic.
As they would, though. I mean, you would expect that from an organisation like Vale.
And look, and if they weren't, they could have pulled the pin at any time. And they've continued putting money in, and they're continuing to do that right now.
All right. Look, Paul, thank you for your time.
Thank you.
It's a really good update. I think there's more to what we can do in terms of getting this kind of content out there. But Paul, thank you for your time, and let's keep in touch.
Thank you for having me, Noel, and sorry for the slightly disjointed discussion.
No, it's good. It's all good. It's always good to get that casual conversation to bring out that story out for the guys out there. So
okay.
Thank you.
I was looking over there. Okay, thank you, Noel. Okay. Thanks. Okay.
All right.